Today on a special Thursday episode of Crowd Forecast News, we discussed projections for the S&P 500, Fed actions and the speech in Jackson Hole tomorrow, outlooks for gold, energy prices, and inflation, as well as the symbols XLE, MRO, QQQ, GFI, and more. If you find today's information helpful, be sure to hit the like button and subscribe. And now here's the episode. Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News for August 25th, 2022. We are recording this at 1 p.m. Eastern Time, and this is the 356th episode.
Wow.
My name is David Kosmider. I'm the creator of TimingResearch.com, and today is actually the 8th anniversary of the first episode of this show. So we're doing a special Thursday episode, and 8 years ago today was the first one, so special landmark. So today I have arranged for a couple of my very first guests from the early episodes, Sonny Harris and Michael Filighera are with us today, and the option professor is back to moderate. So I'm going to go ahead and turn it over to him.
Okay, thanks a lot, David, and welcome everybody to the anniversary edition here today. And the markets certainly are giving you plenty of action this year. We've had 400-point up moves, 400-point down moves, 400-point up moves, all in a matter of 6 or 7, 8 months. So certainly we're not hurting for volatility this year, and it'll be interesting to see how it plays out from here. But today we have two guests, and they're going to give us great information because one has her own technical indicators called Sunny Bands. And the other gentleman is very versed in many different technical analysis, including Elliott wave and Fibonacci. So we're going to get a good dose of technicals on what it looks like right now from these two guests. So let's start out by introducing each other. First, let's start with Sonny Harris. Sonny, a little background on yourself and what's going on at Money Mentor.
Well, moneymentor.com is my website, and I have a tremendous collection of resources there for any trader who wants to learn things. And I'm a veteran trader of 41 years, professional trader, a mathematician, and I have a podcast called The Sonny Harris Show, and I just posted David Kosmider's interview last night late. So if you want to listen to David and have a fascinating hour and a half, go to moneymentor.com and click on podcast.
Absolutely.
Yeah, and I will also include a link to that in the archive information for the show.
Great. Thank you.
Perfect. Great. All right, Michael, tell us all about yourself and what's going on at your company.
Okay. Hi, everybody. I'm Michael Filighera. As with my esteemed colleague, Sonny Harris, I also have about 40 years of trading experience. I have traded as a market maker here in San Francisco, on the London traded options market, the European Options Exchange in Amsterdam, and also on the DTB, which is the German exchange. Currently, I am back in San Francisco, and I have switched from being an options market maker to day trading. And so my focus is on the S&P and the NASDAQ future. And what's going on in my company? Well, I am working together with Mind Muscles Academy and Richard Friesen, and we are putting together a very dynamic workshop series, and it'll be over 60 days, over a 2-month period. And we're going to be talking about strategies and mindsets and everything that gets in our way to becoming successful traders.
Okay. All right, guys. We have got the question of the day, which we normally ask on Monday, where you have 4 days of time risk. But here we're going to ask it on a Thursday, and you got 24 hours of time risk. So the S&P opened today at 4155. It's kind of right around the same neighborhood now. Where will we close tomorrow after the speech in Jackson Hole? Higher, lower, the same? And what's your level of confidence? First over to Sonny.
Well, that's a difficult question.
That's why I ask him.
It's a yeah, and then you're going to report on what happened, right?
We're going to put it in the San Diego Union.
Times. It's it's a difficult chart to read. On my sunny bands, the dynamic moving average is flat, which often means congestion, or usually means congestion.
Now, you want to throw that up here so we
Sure, I
can all
can do
take
that.
a peek and not
I can do
work
that.
out of the blind?
Here we go. You see that now?
Yeah,
Yep.
we can.
Okay, doke. So right out here at the end, this is a daily chart, and you can see the gold and purple lines, that's the dynamic moving average,
Uh-huh.
are flat, which means that probably we're going to bounce up against that and go on down a little further to touch this, what I call the lower inner band. So I think we're going down to 4101.
All right. And what's your level of confidence in that?
I'm never more than 50%.
Yeah, well, because like I
you
say,
know,
you're on a ledge right here. This isn't really a great time to make a huge decision because clearly we could break either way. We could go up and fill those
Oh,
gaps.
yeah.
You know, S&P's got gaps at 42, where am I at? 42.25 and 42.80. It's not it's not unheard of. We could go up and fill those gaps and then dump next week. So you don't know.
That's
Yes.
true.
Yeah. But anyway, so your feeling is 50-50, but you know, with a little bit maybe upside potential, but then a rollover at some point.
Yeah, and if we go above that flat DMA, then we're going on up to the upper inner band, which would be at 42.60.
Yeah, which is
So
closer
that's what I
to,
do. I let, price tells me everything. So
yeah. If they're going to go fill up those gaps, it's probably going to test that green line above your gold and purple.
Yeah.
And then that since it's pointing down, it might be a deal where it hits it and turns down from that level. So you might
Very
save some,
likely.
if you wanted to sell something, you might want to save some powder for that price rather than just going in here hog wild.
Right there.
Yeah. Yeah.
Right. through
Yeah.
there.
See, that's the first gap, 42.25. So.
Right.
So that's and the other one is around 42.80, 42.70. So both of the numbers you have on your bands coincides with these gaps, which is pretty interesting because it really might be the month of September that we get whacked if we're going to get whacked, as opposed to going into Labor Day, where people tend to be a little bit, before holidays like Memorial Day, they tend to get a little giddy or they don't want to do much. And so, sometimes it rises going into these holidays.
Is Labor Day coming?
It is, my dear, right after next week. Labor
Oh,
Day.
yeah.
Labor
Wow.
Day. Yeah.
Labor Day is Monday.
Yeah,
Yeah.
but I'm saying, they start going to the Hamptons by the end of next week. You know what I mean?
Right.
Yeah, especially if they're up money. Okay, so anyway, Michael, what's your call here? We're at 41.55 as a starting point. 24-hour hit.
Yes.
There you go.
Can I switch over and I can also then just show my screen? There we go.
Yeah, you should be able to now.
And I'm going to show that one. Share. Okay. So on my screen, I am showing, let me get that open. So here we are. And what I have going on is that the market continues to follow through on an internal B wave. It's an intermediate degree, so it has a little bit of oomph to it. And right now within that, it is finishing its internal B waves. It's just like we're in a corrective phase, and you're going to get a whole lot of ABCs instead of 1, 2, 3, 4, 5s. So again, we're in a B wave up, and it had targets. I had targets this morning at 41.88, which is where the 200 EMA comes in, and I thought possibly if we got enough steam, it could get up to 4,200. That does not seem to be the case. So I may have to market complete here, which would suggest that we're going to get a little bit of a slide down. And I'll tell you, I have strong support at 4,100, just like you mentioned a couple of spots where we're going to find it. I also agree with that. So I think that what the move needs to do is basically just get itself below 41.10. Then it can complete. And then I get another ABC, and I think it probably should come under 4,100 a little bit, maybe down to 40.64, but it's going to be quick. And it may be due to what Powell has to say tomorrow. But then, Jim, I would be looking for a very dynamic rally, which will take us back above 42.28. And then the big collapse that everyone keeps talking about.
Okay, well, we'll have to see how that shakes out.
So anyway, to answer the question,
Yeah, right.
lower.
Laura, okay. And I wanted to give a sidebar on options, a little example of why the short-term options can be extremely risky, because all the time premium and all the volatility has to come out of the options by the time they expire. So if you buy a 1 week or a 2 week option, whatever you're paying for it, if they're out of the money, they have to come out of the options by expiration. So as an example, NVIDIA announced earnings last night, right? And not everybody, lots of people were betting on calls at 180 and calls at 185 and puts at 170 and puts at 165. And those strangles, which they're called when you do both at the same time, those option strangles might have been going for $500 to $1,000 as much. And just today, when they announced, and then today's action, they still, these options still have 2 days to go on them, but they've all lost. Some of them have lost as much as 80 to 90% value in the first hour of trading. So that gives you a little idea. And of course, when everyone is buying an option, somebody's got to be selling it. And if it's market makers selling these options, they're going to be in heaven if NVIDIA can stay under 180 and above 170, because all that premium will be in their pocket. But if they're smart, and I'm sure they are, they probably have bought back all the options that they were short, because once they go down 90% in value, you're not getting paid anymore to hold on to them. So they probably already are gone. But it just gives you an idea how people can bet on volatility. And if it doesn't show up on short-term options, your money goes out the door very, very rapidly. So I always, when I do my sessions on option trading, I always warn people about, how they can be a real feast and famine, and generally famine type thing.
Yeah.
So
that's actually a very, very good point, Jim.
Yeah, because it's a real example, because everyone knows NVIDIA. Everybody knows they announced it last night.
Right.
Everybody was expecting it to be down $20 because their earnings stunk, and their growth rate has gone from 60% down to 17%. So obviously the whole world probably thought it was going to dump today. In fact, in the aftermarket, I think I saw a 163 print, and now the darn thing is pressing 177 or something. So
it's exactly right. It's exactly where it is.
So it'll be very interesting, but it's a really caveat emptor for those Latin people who don't speak Latin. That means buyer beware. When you're doing extremely short-term options out of the money and you're paying a good premium, you are going to get whacked pretty hard if the volatility doesn't come in. And even if the volatility does come in, they got to take all that time premium out of your option before you get your pay. So that's the way it works.
Great point.
Yeah. So anyway, let's get back on track here. Sonny, what shall we say things are you looking at possibly? I know you look mostly at the technicals, but what are your Sonny bands showing on some of the different markets? Let's look at Sonny bands on stuff like stuff that's moving. People are making money in crude oil. Energy stocks. Yeah, XLE and XOP.
When I look at the futures contract, because I'm a futures trader, but you want me to share again?
Yeah.
Okay, good idea.
So we'll start out with crude, and then we'll look at XOP and XLE and get an idea if there's more room to go, or it's at the top of your ranges, or what do you got?
Well, we're hitting on the crude. We're hitting this is the futures contract. We've got another flat DMA, which priced hit today,
right?
And chances are it's going to go, I think it's going to go back down and hit the bottom band.
Okay, so you think this rally may run out of steam here, because there's a lot of talk on energy because the reserves are quite limited. We're supposedly coming off the strategic reserves issuance, and OPEC Plus are talking about cuts, and they really would like to get the prices to 100. Now, what they want to have and what does happen is two different things. But right now, you think that there could be a little resistance right around this neighborhood.
I think we're going to drop to 83, and that's kind of unheard of. Like that's not what people are expecting, but I think it's what it's going to do.
Well, that would certainly help the inflation numbers and help the Fed with their tightening.
Well, look at this I call these things attractors, but look at that horizontal line. How many we hit it here, hit it there, and now we just hit it down here.
Yeah,
I think that's where it's going to drop back to. And the other thing is that with the gold and purple lines, the purple is on top, which signals bearishness.
All right, let's take a look at the two ETFs that really cover this thing. XLE, which is your Chevrons, your Exxons, and that kind of thing.
And that looks like it's going up.
Yeah, that's the stuff that I'm involved in.
The price of gold, crude.
But again, these people can be very profitable even at the prices. So, crude could go to 83 or 84. These guys are still going to make a ton of money.
It's true.
So that's the thing. There is a disconnect between the price of crude and then the price of crude has gone up way more than these stocks have from the standpoint of, if you go back and look at a monthly chart, on some of these stocks, they've got a lot of room above. But anyway.
Well, there's a monthly chart of XLE.
Yeah. And XLE is pretty heavy into Chevron and Exxon, which have really made their moves. But if you look at it.
I have a chart in my upcoming book, my 7th book, which ought to be out in about a month and a half.
Right.
And it shows the price of crude compared to the price of gas at the service stations.
Right.
And they're not always in tandem. A lot of times the price of crude will go down and gasoline stays high.
Yeah. Well, let's look at XOP. I'll give you a for instance on one that I was going to show you that had, after we look at this real quick, I'll give you some specific names. But this one also looks like it's got, a little strength going on, huh?
It does. Strong.
Yeah.
Right there's where the attractor is, though. It's coming from this line, this yellow dot back here.
Yeah.
You can see it's just exceeded that attractor, which could easily mean it's got some more room on the downside.
Yeah.
Straight.
In other words, this could be peaking out a little bit and then come back down.
Yeah. And of course, Michael can count to 5. So 1, 2, 3. We could go on up further if it's a 3 a little bit. But then we need to come down or at least sideways on a 4 before we hit that 5 wave.
And the 5th wave sometimes is one of the stronger ones, I think.
It is. Extended 5ths are common.
Yeah. Let me give you a couple of names here, like MRO. And go to the monthly graph, and it gives you some idea of what could occur. If
MRO
really,
that means most recent occurrence, right?
Yeah, it means. But anyway, is this go? Yeah, how far does this go back?
Goes back.
03? Oh, 08?
03 is there. Yeah, I can make it longer if you want.
No, I just looking at around. I got it at 07 going up to as high. Is this MRO on mine? I got it at $65 back in 07, 08.
07, 08. We've got a yellow dot at the top here at 46 on mine.
MOR. Why would I have different prices than you?
Did you put MOR or MRO?
No, it's MR. It's Marathon Oil. MRO.
Well, there's the monthly contract on mine.
Yeah. Interesting. Well, anyway, whatever it is, there's some upside from here.
There's
when
upside
it's
potential,
Yeah.
I think, right there.
And the darn thing's at $26. So, I thought this thing was a bargain, anything above 20. So it looked pretty good.
Yeah.
Another one is Halliburton and Schlumberger, HAL and SLB. If you look at a longer term graph, you get a different perspective.
Here's monthly of Halliburton. It's come down. It's touching the midline right there. I think this is gold is on top. So I think we're going to bounce and go on up on this.
Yeah, this is where I think some of the potential is, because they're in the exploration and development and the refining and stuff. The other one is Schlumberger, SLB.
Same story.
Yeah.
I think it's going to bounce on the midline and go on up to whatever that is right there.
Yeah. So energy could be
There's
quite
the
interesting. I mean, it seems to me like it's either going to go one way or the other. And the one way is obviously that supplies will be tight and the winter will be cold and, the stuff will get going. Or since everyone seems to be leaning that way, by the time we get there, maybe some things will be resolved. So it'll be interesting.
Like it's going on up to 59.
Yeah. Yeah. And then there's a natural gas one, RRC.
RRC, I've never heard of that one. And this one has room to go up. It didn't even touch the midline, so that's very bullish.
Yeah. Well, natural gas prices are above 10 for the first time in a long time here, and the gas prices in Europe are just off the charts.
Oh, they've always been off the charts.
Yeah.
It's like a cup of gasoline costs $5.
Let's take a quick look. And Michael, when we get to you, you'll go over some of this stuff the same way, but only through your own mechanisms. The gold, GOLD, because it definitely got very weak, but it's starting to get some legs. And if people start thinking that the Fed is failing at fighting inflation and failing at slowing down the economy, this stuff could get new legs in the fourth quarter. So what do you
If
think
you
here?
if you look down here at the bottom, this histogram, which is the vertical colored bars,
Uh-huh.
right there was the sell signal right at the
Yeah,
top
yeah.
of that move.
Yeah.
Because it turned red, 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 and now it's gone into purple, which tells me it's going on further down.
Yeah. This is Barrick Gold. Can you get the actual price of gold up there?
The futures price,
There you go. Yeah, that's what we're talking.
1771.
Yeah. So, you know, like I say, yeah, I thought that 1760 neighborhood, it penetrated it for just a short time, but those, what do they call those wicks? Look like,
Yeah.
well, I'm not a specialist in that, but is that a long wick?
Bottoming tails.
Yeah. Does that kind of mean a climactic selling or no?
Yes,
Uh,
usually.
it
They
could.
sold right down to that lower inner band.
Yeah.
And that's what that wick represents. And then it went back up and closed still lower, but a higher low than.
Yeah. It's to me, it's the
Still
same
on
story.
monthly.
It's the same story. You know, your gold and purple there really, you know, similar in the area of this 1825 to 1850. If you can get above there, then obviously the air could come back into the balloon. But those green lines above are ominous, huh?
They are.
Yeah.
They are indeed. But I don't know why, but emotionally.
Yeah, emotionally.
Emotionally, I feel like it's going to hit 2000 again.
Yeah.
But from reading the chart, it looks like it's going to go on down.
Yeah. And if it did hit the areas of 1990 or 2100, it looks like they'd be running smack into some resistance. So people might get overly bullish there. And that might be the time where it would be done.
Yeah.
Maybe.
You know, and people who, you know, people who'd like to offload their gold, maybe big players, they'd probably like to see a rally up there with a bunch of public buying and sell it to them there. Because a lot of times you'll see the markets will go one way before they go the other.
That's true.
You know, in other words, they flush it in 2020 during the COVID, they go down to 2174 for like 2 days. Who's buying down there? It's the market makers. And who's selling? Everybody who's panicking. So,
Right.
and that was the end of it. You know what I mean? Just
Yeah.
like on the gold, who was buying this gold up at 2160 before it fell back down back in. One other thing I was going to ask you guys is, you know, I'm looking at this 2013 to 2019 time frame for the gold,
Right.
and that was a
Can
time
you hold
where,
on a second, Sonny? Can I take the screen?
Yeah. Oh, sure. Go ahead.
yeah,
So
because that time frame's interesting to me because if inflation were to come back down and they kept interest rates high, that could be a similar time frame, and that's not very good for the gold.
yes and no. I think that gold, now I'm going to move mine out to, let's look at, I'm going to go to the weekly chart because that's really puts a lot. Gold had been in since July of 20 or August of 2020. So now we're 2 years into it,
Right.
a correction, and it remains within a C wave down. Now, there's still a strong possibility that the 1681 low from actually 1678 from July did put in that low. I can mark this as a C, put a 4 underneath it, and that would send us into a nice fifth wave rally up. Now, if this is the case, again, just on an Elliott basis, Elliott always recognized that in precious metals and commodities, it is not the third wave that is the longest and the strongest, it's the fifth.
Right.
So here we are entering into a fifth. And so I've always kind of been resting on like, well, I think we're pulling back in anticipation of this major explosion that's going to be coming. And there's a myriad of reasons. But right now, as you noted, Jim, what's really holding this back, I mean, when was the last time we saw the euro dollar at parity?
Oh, yeah.
Right. So you got that going on. That's really upsetting the gold rally apple cart. But then just other factors start to weasel back in and gold chugs up higher a little bit.
Yeah.
Then somebody realizes, nope, you're supposed to be a seller because the dollar's rallying and that's just blah, blah, blah. So they knock it back down. I think eventually that whole knee-jerk type of a situation will end. And the cause to buy gold will become very apparent, whether it's going to be seasonal or whatever, the reason for gold to go up will become very apparent. And it could be a short squeeze.
You know,
Could be a short squeeze.
18% inflation anticipated in the UK for the winter time.
Really?
So that's, oh yeah. And that UK is not the Banana Republic. I mean, that's a big place. And 18% because they're looking for, you know, the inflation to continue. You know, people have money, and once a vendor raises prices, it's not as bad as if you raise somebody's wage, because you can't go back on that very easily.
Right.
But you're not going to go back on higher prices until people make you do it.
Right.
And they're not making you do it when they keep spending money and they're running up their credit cards.
That's true. And I also think that the UK, along with Europe, are confronting some energy concerns, you know, in terms of natural gas, in terms of oil, in terms of everything that they need going into winter.
Right.
So, yeah, I can see this 18% inflation rate kind of just knocking them to their knees. And we'll see what happens.
Do you think if it knocks them to the knees, that's going to spill over here?
I don't know if it necessarily is going to spill over here, because I don't think we're in the same type of a situation. Now, how will it affect the United States? Of course, it's going to be coming down to what happens to our own natural gas prices as we move into winter and that the demand goes up. You know, just simple supply and demand equations come flocking in, and you're going to have all kinds of things then hitting a market, right? In terms of energy, it's like if you're short crude, if you're short natural gas, and you get it could be part squeeze, part supply and demand. It's just going to be all kinds of things. So yeah, I think it really could spill over, but as to what degree, if it really would tack on an additional 9% to our inflation, I don't know.
You know, that US dollar I did a little history on, and it's had 3 20-point runs on the dollar index. In the 2003 neighborhood, it went from 70 to 90 area. And then 2013, it went from 80 to 100. And then just now it's gone from 90 to 110. So I'm really looking at this 110 neighborhood as an area. If I get any sell signals on it, I think, you know, starting to buy into some of these foreign currencies that are way down, like the euro, might not be and the British pound. That might not be terrible, because the news out there on those areas is terrible, and their prices are way down. You know, their currencies are way down. Right. And so if obviously the dollar index is heavily weighted to the euro, and of course the euro and the British pound are like brother and sister a bit. So if we can see some kind of I mean, can you put up dollar index, and is there anything telling you that this is a fifth wave up, or anything telling you anything climactic might be happening?
Let me see if I can move this out to the monthly. 8, 2, 3. It's a very difficult chart, but I would say that there is strong potential, even on the maximum monthly. It's kind of overbought over here, but it's not stopped it. It's not stopped it, and when it pulls back, it's not pulling back very far, Jim, off of that 110.
No. Well, I mean, that's why it's a wait and see kind of deal, right?
Well, you know, I'm kind of going back to see what happened. Here's your 2002/2003. And it dropped, it really collapsed. And then we went through our own little economic collapse here.
What about in 2002 at the 112.5 level? Wasn't that really the shot, you know, right when it broke 112.50? And then, of course, when it broke 110, it really went into the dumper. So if that was support that cracked and caused a big drop, couldn't it be possibly resistance on the way up?
Yes, and it's sitting right there at 111.42 if you follow the line all the way across.
Yeah. So it's I see it as a monitor deal that you think could very well happen, but you need a little price evidence and maybe some relative strength turnover or some stochastic or some moving average starting to curl over. And, you know, once that, like say this, but this thing is so far ahead of its lines, you would think it might really, it may take months. It may take months, right?
Well, here's the other point that I want to make. You made a very strong point, and that's the crosses. You've got the British pound, you've got a lot of them, and they're looking very attractive.
Well, they're looking very lousy, look attractive price-wise, yeah.
Yeah. Oh, yeah. Very attractive price rise. Absolutely correct.
I mean, you got to figure how much bad news is priced into these things when they have gone down like this. And
again, Forex traders being Forex traders, you would think quite a bit.
yeah.
So, but I like what you're mentioning, and I think that that's important for people to understand. So I would keep singing that tune. I would keep talking about those crosses and how that will affect us and how it affects them and what is it really telling us moving forward. I think that was very good. Thank you for
Michael,
bringing that one in.
can you squeeze this chart up a little bit so I can see further to the left?
I don't think it will. I think that's it. That's my max.
Okay. All right.
Oh, you were wondering to go even before 2001?
Yes.
Yeah.
But
Well,
I think
Thinkorswim
right
actually,
there where he's got the cursor right now, that's a very strong attractor. It's hit several times over left and all over in the right third of the chart.
yeah,
That
103,
looks to me like it could fall back down to that level.
and then rally again.
Yes.
Yeah. Oh, absolutely. Just a pullback, sure.
Can we
I
look?
would think even within this one, Jim? It
Yeah.
kind of looks like, yes, this would be like 1, 2, and this is the third. And yeah, Sonny, you hit that one on the head. That's good. It pulls back to that 103 area
Yeah, I think that's what it's going to do, right?
and then rallies
there.
again. And
Yes.
then, Jim, if it rallies off of 103, wow, then you really are looking at a test of 122.
Yes. I think that's more. Let's see. What's the dollar index on mine?
Well, if Fed funds is going to 4% or more, then we're probably going to 122.
You know, you're right. And do you follow the? I get all the auction reports now directly from Treasury, and I have to tell you, I've not seen a downtick yet. And even in the Fed funds, you know, the Treasury, the bills.
Yeah. No, the treasuries are actually way back above 3% now. That today they're backing off a little bit, but they've gone from like 275 up to 310 in the last week. You know,
and none of them have downtick auction to auction to auction.
Yeah,
and this is every week.
Yeah.
So I caution people to be listening to a narrative about, oh, they're going to relax. That's not what I'm seeing. When we look at the actual auction.
I was listening to Esther George. She's one of the Fed governors out of Kansas City. And she said, yeah, you know, mortgage rates have doubled. So obviously new sales are down, but we're not seeing prices fold very much at all.
Right.
So they want us, they don't want to hear like, you know, jobless claims went up a little bit 1 week. They want to hear, you know, that, you know, prices of actual real estate are dropping, you know, prices of well, they're not dropping like, you know, inflation going back to 2%, you know, they're dropping, you know, and they don't forget dropping from what, you know, a house goes from 800 grand to 1.3 million, goes back to 1.15. I mean, you know what I mean? That's what's happening. Nobody's discounting their house and giving it away. And the banks, like I say, the rates are so low, you know, people can afford these houses, even if it goes down. Whereas, you know, it's not the same case as it was back in 08 when the banks were underwater and getting all these houses back. That's not,
well, that's true.
That's not happening. So anyway, this idea of this 2% is going to kill inflation is a joke. You know what I mean? This Fed funds of 2%, you know, 2.25, 2.5. That's not, I don't, yeah,
I'm glad you said that.
Yeah. Well, hey, listen, and the joke is either going to be, you would imagine, that they're either going to have to be much more aggressive or the wheels could come off a little bit. And that's what may send the metals up.
So let me ask you, don't you feel that they are the undertone of what we're hearing is they are saying we're going to be more aggressive? They're just not using those words?
Well, I think so, but they also are acting as if they have all the time in the world to get this thing under control.
Mm-hmm.
In other words, you know,
that could be the danger button. Yeah.
I mean, you know, because they had it so ridiculously low, you know, it's you know, zero interest for 12 years, you know, and then the balance sheet is the big key. They printed a ridiculous amount of money in the 12 months around that COVID. They overdid it.
Yes. Huge.
And now they're trying to withdraw it, you know, and when you withdraw that kind of money from the system, because bonds are either bought by the Fed, who prints money, or they have to be bought by dealers who have to put their own money at risk.
Right.
And when and if there's an avalanche of selling, the dealers will not put up their checkbooks. And so the Fed has to come in and be the buyer.
Right.
And the dealers know they're going to do that because the Fed can't let the system go down. So
I think you just now stated another really important point, I think, for people to truly understand. And that's the functionality of what happens and who ends up holding the bag.
Yeah.
And why aren't the big institutions willing to go, okay, well, we'll go in and buy these bonds, we'll give you our dollars. Because I think everybody's waiting out there to see who out of the big holders of our debt already is getting a little ticked off and willing to step in and say, yeah, we're done.
Yeah. Okay. And if they do sell into an environment where only dealers are on the other side, it could be very volatile as far as the interest rate. Some people have a good case that we had a tremendous bubble that popped back in 2020 when the rates went to 0.5% on these bonds. And now it's unwinding. And it could get messy. It could get messy. And if it got messy, of course, that creates a lot of problems. If you saw the Treasury note jump to 4% or 5% from here on some kind of a event, that's going to be, and maybe the Fed would like to see the stock market go way down because that money comes out of stock and goes into bonds. So that's where you'd get your natural buyer by getting people out of stock,
Yeah, that's a true story. There you go. This is all good stuff. Thank you, Jim. You're done really good stuff today.
Well, like I say, you're around long enough, you see how they kind of maneuver things. In other words, like when they're printing $9 trillion, you don't want to be short the market. You know what I mean? When they are, they create 14 facilities to buy junk bonds and everything else. You don't want to be going against them. But for some reason, everybody's going against the Fed now. In other words, they're hiking, but people are acting as if that's not going to have an effect on earnings. It's not going to have an effect on the consumer. It's not going to affect anybody.
I think that is a lack of experience.
It looks as if they already priced it into the market before that first 75 basis point.
But how much should we? I agree with what you're saying, Sonny. But my question would be: it's like, how much of that is like really? Do we really feel that that's what they put in? And that's where they stopped, and now they're okay. When that three quarters of a basis point rise has been now the third time tripled.
Yeah.
So I just kind of look at what the situations are, and I feel that the investors that are coming in now, the investors that are really building up their 401ks and their IRAs because they're in that 35 to 45 year range and age, and this is what they're supposed to be doing. And so when I see them doing that, I think that they keep missing some very important components in trying to understand where they should be placing their money for their own future. And I think that, Jim, you've made some excellent points that I think investors need to put into their equation. And one of them is understanding what is going on with interest rates, how it does affect, and what could possibly affect us again in the future. And realizing that it took 40 years to go from the high to the low in terms of yield, right?
Yeah.
And now we're just starting that bounce off of the lows.
Right.
So if it took 40 years to get there, why in God's name would anybody believe that it only takes 6 months to get out of it?
Yeah. There's a couple of guys who are very popular, Kolanovic out of JP Morgan and Tom Lee, and they are believers that we're going up towards maybe 4,800 to 5,000. And the only way I can see that happening is, first of all, you got to get above the 200-day moving average, which is around 4,350. If that starts happening, I'll certainly lean their way. And I think it could happen if the Fed really thinks they're going to go at this slow pace, because, the consumer's balance sheet and the corporate balance sheets are so flush with cash because they printed so much cash that, the consumer wants to spend their money. And so the bottom line is that, if we don't, online retail sales were up 2.8% last report. If they can't get demand to stop, and these earnings that people are so worried about actually come in pretty good because companies are very adaptable to the higher prices, then these earnings do not, if these earnings do not crack, then they're going to be right. And we're probably going to break through 4,350 and maybe go way up if there's no crack in the earnings.
And so, but what time frame are we looking at? Because I want to.
Well, I'm talking about between now and the end of the year. I mean, if
now,
they announce,
great.
Because Q3 earnings come out in 5 weeks.
But
In
now
5 weeks, you're gonna get numbers.
I agree. I
Yeah.
agree, but you're giving fundamental. Now I
Yeah,
want to
yeah,
take
yeah.
a pure technical look to show you how I can agree with those gentlemen that you just spoke of at JP Morgan and the
Yeah,
other
yeah. I
firms.
mean, in other words, the fundamentals will prove whatever the technicals have already done. And so if we start breaking out on these numbers you're talking about, the fundamentals are that earnings came in good.
Well, yeah,
Because
I can
stocks
see
are
that.
based
But I wanna
on their
show you
profitability or
here-
growth rates. You know, and they're
I wanna
based on
show you
profitability
here
and
that
growth.
we and a primary degree is a fairly large degree under Elliott,
Yeah.
right? So here's the top that I'm counting. So
Right.
this is a super cycle wave 3. So essentially what we're now doing is a super cycle wave 4 correction. Within that, you got an ABC on the cycle, ABC on a primary, etc. Well, we finished the first ABC down on the intermediate. That puts us in the cycle wave. So, excuse me, a primary wave. Primary wave A finished there at 36.39. We're in a primary B wave. Within that, an ABC. There's the A. We're getting ready to finish the B. Now then we got a very powerful C wave up. And what could happen in that C wave up? It can be what Elliott called in the irregular B wave.
Okay.
And what that does tell us, Jim, there is potential. I'm not calling it that way. I'm just saying, hey, if somebody wants to tell me there's a potential, I would have to say yes. And the potential is that it can go up and move to a new high. And guess where that high leads out? 5,000.
There you go. And
Wow.
so once you start seeing the 200-day taken out, and in September, if the pre-announcements are we made good money in Q3, then you'll have the juice and you'll have the juice to make that happen. And again, positioning is kind of light and people are concerned still about a drop. And so sentiment has improved and short covering has occurred. But if it's followed by actual sideline cash coming in,
But it'll be a disaster.
And as long as
it'll be a good move, and if you're a short-term trader or you're just an in and out trader, you're going to make a bundle.
Yeah.
But what comes after that primary B wave up is a primary C wave down, and I guarantee you, no matter where it ends up, the C wave will be crushing and destroy accounts left and right like there's nothing. So whatever reason they're going to take it up is kind of going to be partially true and partially just air.
Yeah.
But the decline will be full based on this is reality.
It'll probably also coincide with the Fed going much further higher in interest rates than anticipated.
Very well could be.
Yeah.
Very well.
So that could be a two-legged approach. The earnings come in September, the announcements, and it looks like the earnings are not going to slip. And so here comes the buyers. We drive up to a higher price. The Fed can clearly say they're not slowing anything down at 2% and 3%. So they have to go to another quadrant. And that could be 3.5% to 4.5% or 5%. And at that point, maybe in Q4, you'd hurt the earnings, and maybe that sets up for the slowdown of 23.
Very much so. But again, all I try to do here, you're filling in a lot of blanks on what possibly that scenario could look like. I'm just saying, well, my scenario is like, Elliott Wave says nothing about what's going to cause it.
Right, of course.
It's going to come in and support it.
Right.
And I'm just saying, well, this is what the math and the wave pattern tells me has potential to do. I mean, I could run those fibs, but the fibs go up to 5,000. They actually go above 5,000.
Yeah.
If they really got fire lit under this thing and we had short squeeze and all of the above. Yeah. Oh my God.
Yeah.
No, I because think whatever's happening with that it's going to surprise people. I don't think it's going to be what everybody expects it to be.
Yeah.
Yes, exactly. I agree with that too. I do.
But I think also a lot of people at this point don't know what to expect.
Yeah, sure.
In other words, we're at 43, 4,200, you know what I mean? And, if you want to go with the facts of life, that is Fed's tightening, they're going to make this thing slow down. This thing's on borrowed time. And when they tighten the PE ratio, which went down to 15 on S&P and just recently jumped to 19, it's going to go right back to 15 or 14. So there goes your compression on the PE ratio. And then if the economy slows, bye-bye earnings. And if you bye-bye earnings and then you compress, that's how you get the 3,600 number. If earnings are solid, and they don't hike very much to compress the earnings, or people are saying these companies are still worth more because of their growth rates, will pay 20 times PE, and they come in at $2.50 of earnings next year, about a nickel higher than expectation. Well, 20 times 25 is 5,000, and that's how you get there. So in other words, I would agree if somebody says I'm a little uncertain here. I mean, a 3,600 and 4,800, that's a little bit easier call, right?
It is, but you're going to get something where I think that to finish this little downside move that we're still in, I'm thinking we can get down to like 4,000 or down to 3,900 and then blast to the moon.
Because, the last 4 times the VIX has been under 20 this year. The last 3 times we've gotten a 200-point drop in the market, at least a 400-point drop in the market. We went from 4,800 to 4,400 one time. Then we went from 4,600 to 4,200. And then we went from 4,200 to 3,600. And so now we're back at 43 and change. So going down 400 would take you to that 3,900 area that you're talking about.
And I tell you, it works. It's so beautiful. And that's a great analogy. I like that.
But the VIX has to close above 25 for that. The VIX has to close above 25, 26 to shoot the flare off that it's happening. And it's only now in the 23,
that's 24. What I think people are waiting for. Now, whether it happens after just Jackson Hole's speech, I don't know. But I would like to see this thing do not necessarily a pump and dump, just a dump. Yeah. And then we start to take off. Yeah. And again, it could be perfectly exactly what you're saying. Has nothing to do with anybody else, but it's institutional traders are going like, the technical picture tells me we're extremely oversold. This has happened. This is happening. I'm lining up my VIX, and they step in and buy it.
Yeah.
Who knows?
Well, because these people that missed the move from 3,600 to 4,300, and they're back on this train that it's going back down. If it starts taking out 40, if it starts taking,
now that I missed the move, and now I'm getting killed.
I can't miss 4,300 to 4,800 to get me in.
Wow. Yeah.
So, you already had a lot of people miss a very big move, and now they look like they're right because it's come down 200 points off that point. But if it starts breaking above 43.50, you could get a lot of people who say, "Hey, enough with this; it's dropping. Let's go back in."
Right. And I just think this is what's really great, because it's been a boring August.
Yeah,
trade has been very iffy, sketchy. Yet we had some nice runs, but it's really like coming in and watching paint dry some days. And so I think it's like today is really great. I want to thank you both. I mean, this is really great that we're just really showing that you have some patience.
Yeah.
These moves are going to come, and it's not going to be like this forever.
I like to say there's always another trade.
There's always another trade. There's always another day.
I mean, I thought when I caught the crash of 1987, that was a once in a lifetime event, but it wasn't.
Whoops, you were wrong.
Hey, Sonny, could we look at your bands on the QQQs and the Russell and see if there's anything there that's telling us something?
Find my mouse, we can do that.
Because we already got the ID on the S&P.
QQQ. This is a daily chart again.
Yeah.
So we are under the flat DMA, and we're probably going to go down and hit this lower inner band, if not the lower outer band. Lower inner will be 1122. Lower outers at 307.
I vote for 307.
I vote for 307 also.
And then launch. And then launch.
And then launch.
Higher.
Yeah.
Yeah, because the direction of the bands going up is important, correct?
No, the bands. Okay. The bands are at the DMA going up is the center gold and purple lines.
Right.
That turning up is the governing line.
Okay. That's what makes the outer bands go up or down?
Yes.
So right now it does look a little bit like we've had a big run in the bands, and the bands are tending to try to roll over right now a little bit. You would say that's true, right?
Michael, I'm not the Elliottician you are by any chance, but it looks to me like that's a 3 right there. So we're going to go on down in this. We're at a 4 now.
It's actually an ABC. So the going down part will be in 3 as well. It'll be an ABC down.
Okay.
So on the up part from the 36, from the 269, whatever that low was.
Right here.
It's an ABC up. And the C wave it's beautifully extended. In fact, the C wave was just the monster in this whole thing. And it took us from 200 to, what is it, 280 up to that just 334.
Yeah.
That was the C wave.
Well, you can
So-
see on my vertical lines, the histogram, you can see that called for a short right at this yellow dot. So it's been doing it.
Hopefully you
beautifully.
took it.
Oh, hopefully I did. I don't trade the QQQ, but I took it on the E-mini.
There you go. Yeah.
What about the small caps, IWM?
Well, they've been on fire, Jim.
No, people are saying, but now they've kind of
It's the
rolled
same
over.
pattern,
Yeah.
same pattern, but they have snuck up right above that DMA. See that blue bar right there for today?
Yeah.
Yeah.
That's
Last
pushed out
2
above.
days, Jim,
So,
have just been on fire in the Russell.
yeah.
Supposedly got very low valuations. I don't know.
Maybe that was it.
Yeah. And people are thinking, that the small caps will do better or something like that.
Or not lose as much.
Yeah. Something like that. Something like that.
That's
All
a
right.
lot of traders do that, right? I don't want to lose as much. How about winning?
Michael, is
Yeah, I know.
any other markets, Michael, you'd like her to throw the bands up on that you're looking at, or any commodities? Somebody was mentioning cocoa to me. Is that
Well,
it?
let's look at my favorite one for a second.
Yeah.
I love Tesla.
Oh my
Oh,
God.
okay.
And
Yeah.
they hit their 3-for-1 split here.
Uh-huh.
First you lived through your 20-for-1 split. Now you live through a 3-for-1 split. You got more shares of Tesla.
I do have more shares of Tesla.
Wow.
And it's above the DMA. So I think we're going on up to right about there, which is 343. And we're currently at
295?
294.
294.
295, yeah.
What's
I
your
think-
time frame?
Oh, I don't do time. I can't read time on these things.
Okay.
Yeah,
Just
I don't know.
price.
I never know anything about time. I just know, I think it's going there.
Okay.
So I don't know, maybe a couple months.
I would think that it could get there if we get this nice turn in the index
Yeah.
that I'm looking for.
Yeah.
And then again, like in the S&P, driving it back above 4,300. And the NASDAQ driving it back above 14,000. Tesla will go. Tesla will get there.
Tesla will.
Yeah, a lot of people are thinking that this opening up of China before this election and the stimulus that they're doing is going to drive the industrial metals like copper and Cleveland Cliffs, and it'll also help the overall demand for things, and it'll also help our stock market. So, China coming out of their apartments could have a major effect on things.
Could. Jim, what have you heard about GDX? Anything? I've been hearing that it's bottoming.
Yeah, well, like I say, it's definitely trying to bottom, and certainly 24 to 26 sounds better than 36 to 40. But there you go. If you want to take a shot at it here, but it's still underneath most of the averages. But
Right.
if you were somebody who wanted to take a shot, you just would get out underneath 24.50. So you're risking a buck.
It's actually low risk entry.
Yeah,
Isn't
you're
it?
risking a buck and a half, and there is a double low looking like there. And what do you think, Sonny? Is this thing teasing us that it's going to go up, or do you think it?
I think
could-
it's going to go up to the horizontal line I just drew, which is at 2871.
Get
For
a nice
starters, yeah.
nice 10% pop.
Mm-hmm.
Then maybe
Actually,
pull back.
that would
Maybe
be a
pull
good
back
pop.
to the yeah.
And see all the resistance we have back here in the
Yeah.
from it.
Yeah.
And it's got a little
Yeah.
resistance right there, even. I
Yeah.
think we're moving on up to this. How soon I don't know, but
Well,
But
I'll tell you the truth. And then just off of that previous low where your bottom, right there, it's
there's
going
a
to
nice
produce an
little trend line
ABC.
there.
There's two smaller gold stocks. Actually, there's metal stocks. One is Goldfields GFI.
Isn't
And they-
that British?
I think it's Canadian.
Okay.
But they just bought and they're trying to buy a Yamana gold, and Yamana's another one that looks pretty good. But this one here looks pretty much like everything else.
That's a pretty good bottom, isn't it?
But it's a low risk entry.
Well, that's what I was thinking.
Mhm.
If you can't risk a buck on a stock, you can't buy it.
Look, it went down and held 850, Jim. I think it's a very low risk entry for at least a run back to 10.
Yeah. Yeah, right there's another attractor right there.
Yeah.
Yeah.
1055. So that looks like where it's going.
And what about AG? It's a silver deal. Technically, on the longer term graphs, it looked pretty good to me too.
Yeah.
This is
I've never
majestic.
been a
gold.
fan of silver. Let's see, we've got an attractor right there.
Yeah.
Looks like it could do the same thing. Looks like
Yeah.
it, and that's
Yeah.
at 950.
And it's above your green, gold and purple, right?
Yeah. Oh no. Oh, you mean price is, yes, it just today turned gold,
Yeah.
and that's a buy signal.
Yeah, that's what I thought.
Yeah.
And like I say, the volume, they do big volume, millions of shares trading.
Wow.
It's one of the better looking ones out of all of them. You know, I look at Pan American Silver, PAAS, because I always thought that was more one of the Cadillacs of the silver. But that seems to be a little bit, dead
That one
legs.
looks like it's still going down.
Yeah, that's why I didn't think that one looked any good. But you know how it goes. If the silver were to start going, that'll play a mean game of catch up. But I wouldn't want to hope on that. The other one, at least you have some net underneath you with the moving averages.
Mm-hmm.
So, all right. Well, we're at the top of the hour. Let's let everybody know how to get a hold of each other and also what free offers you might have, if any. And let's start with Sunny.
Oh, free offers. I have a free Sunday night sunny side of the street technical letter that I send out. You can get that on moneymentor.com. Just sign up as a free member and you get that. I also have a free trading room every Tuesday morning at 7 a.m. my time, California time. And anybody that's interested, I'd be happy to give you a 20% discount off of any of my products if you just mention this show.
Sounds good. And it's moneymentor.com.
Correct.
Perfect. Michael?
Hi. Again, you can get a hold of me by sending me an email at michael@mjf1partners.com. And coming up, again, we're calling it the Super Strategy Supercharger. And so we're going to be dealing with all kinds of issues that affect traders and their success. And if you would like to get to the sales page about it, and at that same time, you should be able to take a look at the video that we did a webinar yesterday. That posting will be up shortly. That link, and let me put it down here in, where are we, chat box. And then David, if you would be so kind to, this will take you over to the sales page. It's being done by myself and MJF1 Partners or Logical Signals in conjunction with Mind Muscles Academy, which is founded and run by a very good friend of mine from our trading days on the Pacific. And that is Richard Friesen. So we're combining the psychological and the technical.
Sounds perfect. Okay, guys, as far as Option Professor is concerned, if you go to our website, optionprofessor.com, you can find out how you can get 2 PDF reports. One's on how to hedge against market declines and upside surprises, and the other is our best technical indicators. And we also have a one-on-one review on the market you're looking at, as well as strategies you're using, and you can get a fresh look using our approach and see if it'd be of value to you. So that's optionprofessor.com. Go check it out and put your information in, and we'll come back to you and explain how it works. Okay, David, first of all, I'd like to let's all thank David for putting these things together for so many years. It's been fantastic. And let's hope we have 8 more good years ahead of us.
Happy anniversary.
Happy anniversary, David.
Yes, definitely. Thank you. Many more years ahead, hopefully. So, thanks for joining us for the 8th anniversary episode. And just a reminder of other things. As Sunny mentioned at the beginning, my episode of her podcast was just published last night. So there will be a link in the archive episode, or the archive info to find that. Also, Michael and the Option Professor have done previous episodes of Sunny's podcast, so you can check those out as well from that link. And actually yesterday was, well, not yesterday, Tuesday was the 5th anniversary of the Analyze Your Trade show, which is now monthly. And so everyone, please be sure to mark your calendar for the next episode of that, which will be September 1st at 4 p.m. Eastern Time. And Samantha Leduc will be the guest for that one. Also, be sure to mark your calendars for the next big Synergy Trader event. That'll be September 6th, 7th, and 8th. That'll be Fibonacci and Elliott Wave will be the topic for that one. And you can simply go to TimingResearch.com to get access to any of the live episodes or events as they're happening. So yeah, just final. Be sure to subscribe to Timing Research on YouTube or your favorite podcast app to get instant access to all future events and recordings. And you can just go also to TimingResearch.com to get the recordings there as well. All 8 years, all events and presentations are all there for anyone to review whenever they want on TimingResearch.com. And so I just want to thank my guests again for today, Sunny Harris and of MoneyMentor.com and Michael Filighera of LogicalSignals.com, both early guests on these shows when I first started doing them. So I want to thank them for continuing to be a part of it. And then of course the Option Professor, who was Jim, I can't remember exactly when you were first on, probably about a year after the first show. So and then you've been moderator for a long time now. So thank you for doing that. And
A good moderator he is.
Yes, definitely. So all right. So that's it for today. Thanks everyone. And
Thank you.
David.
we'll be back with a normal Monday version of the Crowd Forecast News next week on that'll be Monday the 29th. All right. Thanks everyone.
Thank you.
Thank you.